ultimately using any of these stats as facts to say, if my business is this big, I'm going to go hire 5 more people, right? Like you think about the burn ratios that we're all managing against of ARR growth to burn. And if you say, well, my ARR actually grew quite a bit last quarter or last year because of the way I'm defining it, I'm going to go hire another sales team or another R&D team. It could be if ARR starts coming down, your headcount doesn't go anywhere and those ratios really get screwed up. You can tell a really compelling story and maybe convince one person or a room full of people. But if it's not right, ultimately, you're going to have to backtrack from it and do layoffs or do other things. And so win the war, not the battle.
Is this thing on?
Yesterday's price is not today's price.
How kind of you, Fat Joe. And welcome to Run the Numbers, where I interview world-class CFOs, operators, and the investors who fund them on how to get the most out of your company's performance. This podcast is a playbook of sorts for ambitious people in the worlds of finance, strategy, and operations. Today, my guest is Todd Rakow, the CFO of Gladly, a leading software for customer service professionals. Todd is an expert in usage-based models and answers all my questions on how CFOs should measure and forecast performance when revenue depends on activity. On this episode, we cover how to accurately calculate ARR in a usage-based model, how net dollar retention rate can help you better forecast your customer usage patterns over time and actually serve as an input to ARR, how to commission sales reps when customer activity can vary and where true-ups come into play, deadly false signals people can take from usage-based models, and balancing being a serious CFO versus having fun and enjoying what you do. Todd goes deep into the ARR guide he wrote for his board and company to describe how they should measure company performance and explains the difference between the reoccurring and recurring parts of Gladly's business model. There's a difference. What I really loved about this episode is how Todd used his own company to provide real-world examples of how a CFO can better navigate the challenges of seasonality and overusage. Todd also takes us through frameworks he's adopted in his own life to be a better partner to his CEO and how he manages his teams with a sense of forward momentum to always stay a step ahead. All this and much, much more after a short word from our sponsors. As a SaaS CFO, I know firsthand how difficult it is to report on SaaS metrics. We've all seen a deal close at the end of the month, but the customer's contract doesn't actually start until the middle of the next month, creating the classic discrepancy between bookings or committed ARR and actual ARR, the real stuff. That's why I'm so pumped to be partnering with Maxio, a company trusted by thousands of SaaS companies to understand these reporting nuances. They basically built and automated the SaaS dashboard I tried to manually cobble together for 3 years. In 2022, SaaS Optics and Chargify combined to become Maxio, the only billing and financial operations platform that was purpose-built for B2B SaaS. They're helping SaaS finance teams automate billing and RevRec, manage collections and payments, and put together investor-grade reporting packages. Visit maxio.com/runthenumbers to learn how Maxio can help you supercharge financial operations in 2024. Request a demo using the Run the Numbers link and receive a 10% discount on your first year with Maxio. That's maxio.com/runthenumbers. If you're a startup founder or executive running a growing business, you know that as you scale, your systems break down and the cracks start to show. If this resonates with you, there are 3 numbers you need to know: 37,000, 25, and 1. 37,000. That's the number of businesses which have upgraded to NetSuite by Oracle. NetSuite is the #1 cloud financial system, streamlining accounting, financial management, inventory, HR, and more. 25. NetSuite turns 25 this year. That's 25 years of helping businesses do more with less, close their books in days, not weeks, and drive down costs. 1, because your business is one of a kind, so you get a customized solution for all your KPIs in one efficient system with one source of truth, manage risk, get reliable forecasts, and improve margins. Everything you need in one place. Right now, download NetSuite's popular KPI checklist designed to give you consistently excellent performance, absolutely free at netsuite.com/metrics. Oh yeah, your boy loves metrics. That's netsuite.com/metrics. To get your KPI checklist. That's netsuite.com/metrics. I really need this, guys. Please go to netsuite.com/metrics. Woo! Well, welcome back to another riveting episode of the Run the Numbers podcast. I am here with Todd. Thanks for joining the pod, man.
CJ, it's great to be here. Thanks for having me.
I was looking through my Rolodex for usage-based experts. Just context of how this came about. We had interviewed Lee Kirkpatrick of Twilio, and one of the points that people enjoyed hearing the most about was Twilio was kind of on the forefront of this usage-based model. And when they went to IPO, he was teaching people a different language, in a sense. A lot of the bankers didn't understand how to value the company. A lot of the potential buy side had no idea how to model it. And I think there are a lot of operators out there who are also sitting there saying, I need to get better at how I manage my own business when it's usage based. And so, Todd, you were at the top of the Rolodex. I don't know if you're a victim having to come on here, but I appreciate your time.
I really appreciate you having me. Happy to speak about that and everything we've gone through it. Gladly to think more about it. I agree with you that it takes getting used to in terms of both how you report on it and who you're speaking to about it and how they understand it. But super important and so widespread and common amongst SaaS companies that it's a great topic to dive into.
And it does seem like I'm a benchmarks nerd, that all of the really great companies that are called out in these benchmarks are usage based these days. Do you think it's just in vogue, or is that truly the way that the world is moving?
Well, if you think about SaaS in general, became much more of a use what you need and not what you don't, in its first phase of growth. And I think the innovative companies have realized, so you could do that as well as beyond what's just contracted, think about how else you use it. And if you're not using it, or if it's, seasonal or whatever it might be, the dynamic around how your customers use your product, the more that you can say, use what you and pay for what you use and not what you don't, is a great selling point in the sales process. So if you can have a combination of both, let's contract so you are officially a customer and we can expect and rely on a certain amount of revenue. And then when times change, we'll charge you for just what you use. Really a dynamic way to go to market. And so I think a lot of companies have seen that and taken advantage of it.
And as a first-time CFO, the first true usage-based negotiation I had ever got into was Snowflake. So I didn't exactly get a softball right off the bat.
Yeah, definitely. I mean, they're one of our largest COGS vendors. And though it's an advantage to pay for what you use, it also means that, if your use goes off the rails as a customer of Snowflake, then that's a problem for you as well. So it's how you manage that from both the vendor side and the buyer side is you just have to pay a lot more attention to it than these historical just car-based contracts that are set it or forget it.
And you brought up a term that I love, CAR. I always say if you want to trick your investors, tell them about your CAR, your contracted annual revenue. So a lot of people will be like, hey, look over here. Look at the huge exit value in year 3 or 4.
That's right.
Just to go back to benchmarks for a sec, do you think there is some sort of translation that needs to go on kind of between the classic SaaS world and usage-based, or is it apples to apples?
I think it only benefits you to do that level of translation with your board, with internal employees, with new investors. I even took it to the point of writing like a little mini white paper on what do I mean when I say ARR at Gladly.
Ooh.
And there's all these different components to it, and I can go into them.
Yeah.
But that's something that I sent around to all of my investors and met with them individually because it kept coming up in board meetings. They were actually misunderstanding how I was doing it. So I felt like taking that step back and really taking the time to provide definitions and explanations of each of these subcomponents saved lots and lots of back and forth. And so it's something I highly recommend other SaaS companies do.
So you wrote like a senior year thesis paper on it. Can you just take us through what some of the elements in that were? What were you trying to get people to understand?
Back to this usage-based revenue piece. The main element was CAR, contracted ARR, super easy to understand. I don't have to spend any time explaining that to most folks what it is. And because we had such a significant, not a majority, but a significant portion of our ARR from usage-based revenue, I really wanted to go through and say, here's how people use Gladly beyond the contracted amounts. Here's how we think about that in terms of how it translates to ARR. And then most importantly, here's why we do that in terms of it actually proving out to be true in terms of if we say we have this much ARR today, here's what our revenue looks like over the next 12 months and how those two prove out. Because ultimately, this is non-GAAP. You can define it however you can convince people to define these things. If they don't prove out in the numbers, then you're wrong. You could be a good persuader, but you're ultimately an incorrect CFO. So a lot of it was just the why behind the number. So we could get past all of that and just start talking about it as a known quantity and not question it.
And part of the tricky translation that goes on is that typical SaaS businesses, hey, I'm just going to charge you the same amount every month, regardless of usage or even how many days are in the month. So I work for a usage-based marketplace where we can't artificially create at-bats with more business days in a month. So if a day only has 28 or 29 days, we have to actually adjust how we look at some of the metrics because there just weren't as many reps that we could get in. And SaaS is reoccurring with an O, in the sense that it happens very predictably every month. You should be able to model it to the T. But the small difference in spelling is that there's also this recurring element to it. I may be getting the two backwards, but can you just explain the difference between recurring and reoccurring?
Yeah, I've seen a lot of earlier stage CFOs trying to jam reoccurring into the recurring word and just hope you kind of don't see the difference between the two. And not maliciously, but they're trying to prove repeatability in their business when there isn't necessarily. I think there's a big difference between, hey, look, this customer buys with us every month consistently, and we're pretty sure they're going to continue to. That's different than this customer has a contract that they have to buy from us every month for the next 2 years. And on top of that, they use the product above and beyond this contract in this very predictable way. That's the reoccurring portion that sits on top of recurring revenue. If you don't have the recurring piece, i.e. something that's contracted, then there's just this inherent level of risk underlying your entire thesis about what your ARR is. And so, every business is different, but I think the more reliable you are in terms of, well, this is a fact, this is known, this is contracted. And then this piece is how they use us historically, and we feel good about that, is different than this customer may just go away tomorrow. We hope it won't, and it probably won't, but there's nothing in contract that says that it won't. So it's a little bit further removed from a core definition of ARR.
And I think that's the thing on the surface, right, Todd, that scares people away sometimes is when you do try to jam stuff into the recurring bucket that isn't actually recurring. It may go away with something like seasonality or big deal risk.
Definitely. And you can be a convincing CFO or you can be a correct one. And I think the more that you're just relying on the convincing side, that's important. I think it's really important for CFOs to be able to be good storytellers and have data to back it up. But the more that you're just hoping that you're right, just the more risk you are opening yourself up to as a CFO and as a company.
Okay, so back to your white paper here, New York Times bestseller. How did you calculate ARR in that model?
Right. So for Gladly specifically, we're customer support software, which means we sell both seats to agents of our customers, CS agents of our customers. We call them heroes at Gladly, as well as AI assists. So all the different ways that AI assists our agents and their end customers in having that interaction with a CS agent. So for us, there's the very easy part. There's the, hey, I'm a customer. I bought 100 seats from you and this much bundled AI assists. That's CAR. That's great. We have usage revenue in that customers grow and we grow with them. And so if they buy 100 seats, perhaps they go to 110 seats and then 112 and 14 and 18. And throughout the year, that will grow. And especially throughout their first year, where they sometimes will buy less than they know that they'll need because they just aren't positive they'll need it. And that's okay. We want to give them that flexibility. But they'll grow throughout their first 4 quarters at Gladly with more seats purchased, more AI assists used, as well as telephony. As you can imagine, in the CS world, they're on the phone with their customers all the time. You mentioned Twilio at the onset. Twilio is integrated in the back end of Gladly, and we use that to facilitate all the telephony services that our customers use. But they don't contract for any of that upfront either. So the longer their agents are on the phone with their end customers, that's all revenue that goes through Gladly's pipes as well, and we make a certain gross margin on that as well. So because we have this usage revenue, we call those extra seats and extra telephony usage and extra AI assist usage because it's not contracted or it's above and beyond what is contracted. We have to think about how to define that as ARR. So again, CAR is easy. And then for the usage piece, we say for all of our customers, whatever they've used over the last 12 months is their usage ARR. Pretty straightforward, pretty uncontroversial. If they've used it for 12 months, even if it's been scaling up or scaling down, it's their 12 months of data on this. And so we add this to their CAR. About 15% of our calculation in total is from customers that are new to Gladly. So they have their CAR, but they don't have 12 months of data in terms of how much they're going to use. And so that we look at the concept of net dollar retention, NDR, Gladly, specifically for customers' first 4 quarters on Gladly. So we say of all the growth, of all the churn, of all the extra seats and telephony and assists, et cetera, what does an average customer use on usage ARR on Gladly over the first 4 quarters? And for us, it's really high because of all those reasons I just talked to you about in terms of we grow with the customers. Sometimes they start smaller than they really will be. And so our 4-quarter net dollar retention in Gladly is about 155%. So really strong numbers. And because of that, if we ignore it and just say, this customer bought 100 seats a month ago, that's all they are to us, we're really ignoring this huge amount of ARR that we know they're going to spend on us over the next year. So we take that net dollar retention rate and apply it towards the car that they bought with us to say, here's how big of an impact they're going to have on Gladly over their first year. And as soon as that year has happened, we stop forecasting them and say, well, were we right or were we wrong? Let's look at their 12 months of data and just shift them to that trailing 12 months amount. So we're really trying to stay with as much real data and as little extrapolation as possible. Again, you want to be the right CFO, not the hopeful one or the persuader. And that's constantly a moving thing over time as customers come off their 12 months and move to being longer term customers with us, and we adjust our NDR rate, et cetera.
Todd, this is brilliant. I got to flag this for the audience because I've never heard it described this simply in a compelling way of how you can use your NDR patterns to actually calculate your annual recurring revenue. Me as a CFO, a lot of times I'm sitting there, I'm like, can I make a call on what a customer is going to do over time if they've only been here for 3 months? And like in the business that I'm in, I should be saying, yes, the ramp pattern is pretty predictable. So I do kind of know where the puck is going in a sense. So I just want to say, like, the way that you explain that totally makes sense. And I bet there are a lot of people listening right now who are saying, I think I could more reliably predict my business that way. And hey, if we get it slightly wrong, we can still do this. I don't know what you would call it at the end. It's kind of like a gross up or maybe like a reconciliation on these new customers.
But yeah, ultimately, whatever they've actually done over this 12 months is what you need to shift to. So if you were wrong, you'll know that when you're thinking they were worth this much and they shift down after those 12 months, but you should keep an eye on it. And if you want to get ahead of that and say, boy, this NDR multiple is wildly off for this one customer, then you could get ahead of that too and say, we thought it would be that. For whatever reason, this customer's not acting that way, so we'll take it down. But it is an average. So some will be higher, some will be lower, and ultimately it should be pretty close.
And just more tactically, people love this inside baseball. Do you essentially have every customer in a spreadsheet with one row? And then if they have 12 months, you can sum backwards. And if they don't, then you kind of forecast forwards?
We do have that. We think about it more from a sales cohort perspective. So all of Q1 deals are starting now. Let's see what happens to them over 4 quarters versus the customer by customer. So we're basically taking the Q1 car that we closed and extrapolating it out. And we're doing that based on the per customer usage historically over the last 10 years at Gladly. To answer your question, it's more about a cohort by cohort basis.
I love that. There are probably also a lot of people out there saying, I've just been multiplying the last quarter by 4 this whole time.
Right, which, by the way, is very common and a totally legitimate way of doing this. And I probably should have started there. We, in the early days of Gladly, would do that, but Gladly sells mostly to the retail e-commerce markets. So, big retail customers that, as you can imagine, during the holidays, their usage spikes. They hire warehouses full of CS agents that are just for the holidays. They use way more AI assist, way more telephony. In January, nobody's liked what they got for Christmas or the holidays, and so they're returning it and they're online doing that. And so we still have a high usage then. So because of that for Gladly, we used to just see this huge spike in ARR for Q4 because we were multiplying it times 4. And that really didn't match well to the ARR and the revenue ultimately we're going to be earning as a business. And so any listener of yours out there that faces this problem of seasonality, I recommend they think about these alternative methods of not just taking a month times 12 or a quarter times 4 to more closely track to what the revenue over the next year will look like.
You gave an awesome example in your industry with Q4 being where a lot of retail sales happen. For me, I'm a CFO for a vertical software company that's serving the auto industry. And something like very weird that you wouldn't know, and I didn't know this until I came into the business, is that our best months are actually right after people get their checks back from the IRS, their refunds.
Oh, interesting.
because they'll delay getting like their brake pads done until they have cash. A lot of Americans out there are living paycheck to paycheck, and now they have this influx of cash. They go and get this auto body stuff done that's been delayed. It gets delayed but never denied. But if I had multiplied by 4, I'd kind of be screwed and shooting myself in the foot, because then when the summer months come, everybody's going to a barbecue and you don't want to get your brake pads fixed. Now I got this huge ARR number that I'm trying to fight uphill to match.
That's exactly right. So it's either spikes in your business, or it could be dips in your business too, for the same reason that you're mentioning, that you want to make sure that you're not overreacting to in terms of stating that's the true size of your business when it happens.
Exactly. And so let's stretch this out. So in perpetuity, though, in theory, right, like your GAAP revenue should equal your ARR?
That's exactly right. So again, back to this, my award-winning paper that I'll publish someday.
Yeah.
I just included a very simple graph, right, which is, here's my theory about why I think this is our ARR. Let's go back test this. Let's look at what our actual recorded revenue was from a GAAP basis over the last several years. And let's look at what I told you our ARR was during that time. And you could see them really closely match. And then I also did a graph of, and here's where it would have been if I had just done a quarter times 4. And you see it go way up, and then it's actually below, and you can see it going up and below. And what that looks like is I've lost a business in Q2. That, you'd look at that and say, oh my gosh, did you guys lose, a quarter of your customers? What happened? And of course, that's not true. And that's not how I'd want to represent the business. And you can see the much more steady up to the right version using the way that we do it. So I think visually, it really helps to show the difference as well.
I've also messed this up, not because of seasonality, but because we had customers at a prior company who were signing up to these massive multi-year ramp deals. And so we were taking the exit value, the car, and using that as our ARR, but the GAAP revenue, like, it kept getting wider and wider. So first they were like 10% apart at the end of the quarter, then they were 12%, then 15%, then 20%. And eventually we had an investor saying, like, what the hell is this? Like, why is this gap getting bigger over time? Shouldn't you be closing it if the growth rate is slowing? And so there may be people out there who are like, oh, wait, I actually made that footfall before too.
Absolutely. I think this is super common. The more we learn and understand about these usage-based businesses. So it's no fault of anyone. We're in this together. We should share these tips with each other. Ultimately, it has to prove out in the numbers. I think that's really the point you're making is, even if it works right now, you have to keep testing it, because it could be that those two lines diverge more over time.
Yeah, and I'm glad I made that mistake then, because it's kind of my starting point now for when I'm at a new business.
That's great.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Well, you know what I always say, maintaining compliance is never complete, which is why most security and IT teams feel like they're always in audit purgatory. I'm there right now. But there is a solution, and it's easier than you think. Escape the infinite loop by using Thoropass's compliance and audit solution. Thoropass is the only solution using AI-infused technology and in-house auditors to take your team from start to stamp without leaving the platform. As a winner of multiple G2 awards, including top awards for usability and service, your team is in good hands with Thoropass. From onboarding with dedicated experts to audits from in-house auditors who know every aspect of your framework needs, you can have complete confidence in your Thoropass compliance journey. Thoropass is the only solution to offer audits for your most needed security frameworks. I'm talking HIPAA to HITRUST and SOC 2 to ISO 27001. Woo! If you need PCI, DSS, pen tests, or any other major compliance framework, Thoropass can hook you up. With Thoropass, you never need to worry again. Relax, we fix audits. Find more at thoropass.com. That's THOROPASS.com. Tell them your boy CJ sent you. They'll hook you up. Boom. Something else that's a topic of discussion when it comes to usage-based models is how to pay the reps who actually bring down these deals. How do you just philosophically think about, commission structures and incentivizing sales reps?
Yeah, we want them aligned with the business always. I think it's kind of number one in terms of strategy towards this. We don't want any component of the sales process to stop or to not happen because their incentives are misaligned with the business, which is obvious. But so the way that translates to Gladly is, because there's this large usage-based piece, what we say is, we'll pay you on the car, again, the contracted amount that you close when the deal closes. But knowing that these customers are going to grow, we will continue to pay you commission on that growth for the first year of its growth. So for the first year of a customer on Gladly, any what we call them true ups, which is extra seats or AI usage that they use, Any true ups that happen, we'll pay you true up commission for the first year that customer's here. So don't stress about trying to make the deal bigger than it naturally should be up front, which might put the deal at risk. And don't put in any roadblocks to getting the deal done because you think that there's money for you to be made that you'll miss out on later on, essentially.
That's what I'd be worried about too. Right. They're trying to like time it and maximize it.
Exactly. Let's get rid of all that. So no shenanigans at all. Just get the deal done and we'll grow together and we'll get paid together is really how I have them thinking about it.
So it is a land and expand model then?
It is, and some more than others. But the whole idea is that we are here to grow with you over time, and we're not going to force you to buy seats that you don't necessarily need right now. We're not going to charge you more for them if you don't buy them right now. Sometimes you see that in SaaS where a vendor will say, buy it now. If you need it in the future, we'll give it to you, but it'll be 20% more expensive. We don't get into any of that either. We really just want to grow naturally with the customer, and we feel like this is a good way to set that up.
And is multi-year worth more to you as a company?
It is worth more to us. And we'll, again, to the commission piece, we'll pay on the second and third year, not at the same rate, but we'll pay on those to the rep to make sure that they're thinking about that in their process. Ultimately, we have really low churn at Gladly. We have a great product, really good customer support team, and we're a really sticky product. So I don't hyper obsess about get that third year instead of just 2 years because, we run our business assuming they're not going to churn at their first available opportunity. If anything, it gives us an opportunity to sell them more things, look at pricing, et cetera, every time there's a renewal. So while we like longer term, it's also, thankfully, something Gladly hasn't had to stress about in the close process because we can stand behind our product and know we'll be partners for the long term.
I love that you said that, Todd, because I always want to be working at a company where we're going to bet on ourselves to A, keep the customer around, and then B, like use the renewal as a compelling event to sell them more stuff because we are investing in R&D at the same time. Like I hope we have another product to sell you by then.
For sure. It is kind of amazing the amount that you invest in R&D and improve in a product. You think about a 3-year deal where you lock in pricing for 3 years and then raise a customer's prices by 5% after those 3 years. We've developed this product way more than 5% in 3 years. So it's very much to the customer's advantage in that sense. But again, we want to reward loyalty. We certainly appreciate that and don't look to jack things up at that point. But we do want to make sure that however long we're signing a customer, they love Gladly, period. And the rest will take care of itself.
I love that. And so maybe to bookend the conversation, at least on usage-based so far, what are some footfalls people should be aware of? It could anything goes, Todd, that you've seen people mess up before with usage-based models. Could be commission, could be the metrics they use to track it. What do you think?
Yep. I think we've touched on a good amount of them with the commission piece, just paying wrong. So your reps will not follow the strategy of the company is a big one. I think the jamming reoccurring into recurring is a really common one. And then ultimately using any of these stats as facts to say, my business is this big, so I'm going to go hire 5 more people, right? Like you think about the burn ratios that we're all managing against of ARR growth to burn. And if you say, well, my ARR actually grew quite a bit last quarter or last year because of the way I'm defining it, I'm going to go hire another sales team or another R&D team. It could be if ARR starts coming down, your headcount doesn't go anywhere and those ratios really get screwed up. So I think the main message I would take from all this is you can tell a really compelling story and maybe convince one person or a room full of people. But if it's not right, ultimately, you're going to have to backtrack from it and do layoffs or do other things. And so win the war, not the battle.
And math allows you to do this fun thing where you can take small numbers and multiply them against each other to get a big number. And it allows you to essentially take more credit, but sometimes it can swing in the other direction.
Yeah. It might feel good in the moment, but not long term. Yeah.
Yeah. Cool. So transitioning a bit to just how you go about your work as a CFO, I wanted to know if you had any frameworks that you use in either daily work life or just how you manage the finance team at Gladly.
Yeah, lots of them. I think the one that comes to mind first is, we all are in Silicon Valley, and Gladly's headquartered here, and we're not building any product. We're non-technical, and we're not selling any product. I mean, I get involved in that a little bit here and there, but generally, sales and operations teams not selling. So you think about that and you feel pretty vulnerable. Wow, I'm not building or selling anything. Well, am I just completely replaceable? Am I just a number here? Am I going to get downsized as soon as times are tough? And the more that you can become irreplaceable, obviously, the better for you, the better for the company. So it's kind of just a broad, what is our value here if we're not doing one of those two things? And the thing I really instill with my team is our value is customer support, internal customer support. So do I have a finance team that I can trust more than anything, right? Are these numbers they're telling me correct? If I don't understand them, can I grab time with them and get a better understanding? If I need a report for a customer on why their usage was this way, can I get that with some sort of SLA turnaround time? And I know the finance team's thinking about my needs to make sure I can keep a customer or close a customer, or whatever it might be. We are essentially these utility players at the company that are going to be called upon to service what everyone else is doing that might be a little more high profile in sales or high profile in being an engineer in Silicon Valley. That's fine. We're not here for that. We're here for a well-oiled machine. And I really try to reemphasize how are you reviewed internally amongst your peers as a CS agent for them. And I think it's just a good mantra to go about day to day.
We had spoken to Brett Queener. He's one of the founding partners of Bonfire Ventures, and he was the first sales rev ops strategy guy at Salesforce under Benioff. And he used a quote. He said, "You either build shit, you sell shit, or you're bullshit." And I was like, damn, Brett, that one cut deep, man.
So we're squarely in the bullshit category here. And if that's the case, then you better be providing a lot of value in other ways.
Yeah. Someone once called me back office. I said, I was strategic back office.
I like that. Just put strategic in front of any title. You feel better about it. And that's okay. The whole point is you have to come in without an ego about those things.
Yeah.
And be invaluable in what you do. And there's lots of ways to do that.
I like how you take the customer support and customer success angle to it. Like, it's appropriate for what you sell, but also it's a nice way to think about business partnering. Because a lot of the business partnering that people talk about is just like this quasi, I'll help you with your budget. But it's kind of like, you tell them what you need and you're like, I'll come back in a couple months to see if you actually carried through with this.
At our stage, Gladly's about 175 employees. It's windows and floors. You have to do everything. I often call myself a janitor in somewhat of a tongue-in-cheek way, but others, and I take pride in that I'm the person who's going to come in and who's going to either that's cleaning up difficult situations or explaining them in easier ways so they don't become difficult situations, whatever it might be. But nothing's below me. And if nothing's below me as a CFO, it shouldn't be below the people on my team. And just that whole mantra and approach towards work where we need to be respected, of course, and you get and earn respect through the work that you do and the partnership you provide people. But ultimately, we're here to make sure that this thing succeeds. In that BS category, I'll call it, that third bucket that you mentioned.
Yeah, I'll sweep the floors. I'll water the plants. I'm not too proud.
That's right. That's what it takes.
But how do you balance being the CFO and having to be serious about some stuff, and then also taking kind of this empathetic approach to working with people? Like, Todd, are you a serious guy?
So the way that I think about this is CFO work is unbelievably serious, right? To understand where your business is and to accurately forecast it and to accurately account for it. These are business-ending things in terms of doing them wrong. You fail an audit, good luck to you ever raising money again, right? If you misforecast the business, you could run out of cash. So unbelievably, keep me up at night, serious level that I take it. And I instill that in my employees too. We talk a lot about zero defect work and striving for zero defect work, which is impossible because we're human beings, but we have to strive for it. We have to try to get there. That said, personally, I find it hard to remain that serious all day long, just, I guess, inherent to my own personality in terms of just trying to provide levity to certain situations. I think you kind of go crazy if you do this job too long and don't approach things that way. And I actually think it's really beneficial to either myself to be able to be myself, but in almost any business situation, if you can provide, what they call levity or humor or just be more human, it helps facilitate relationships, develop trust, allows other people to realize, oh, I now have permission to be myself as well. Like, I realize this isn't just a robotic conversation. I can let my personality out a bit. I've seen it help get deals done. I've seen it help in tense boardrooms where, things are tight. You say one thing that's a little bit lighter, things just tend to loosen up a little bit. People are human beings in that sense. So I'm not doing it to be manipulative in any way, but I'm just doing it to be myself and to show others that they should be themselves too. And there's times to be very serious. And there's times that even if the topic is serious, just like a little bit of a pressure release in a lot of conversations that I'm in, I find helpful. I've heard being a CFO described as just one long series of uncomfortable conversations, which, I can't really argue with. And I think that's the kind of thing where you'll want to retire if that was truly the case. You'll want to retire early. But if you can do it in a way where they're uncomfortable, but they're also human and you're getting the job done and people realize it's not personal, that goes a really, really long way. So something I try to do a lot.
I can't believe I'm saying this, but I think one of the best tools in my toolkit to get people to talk to me is just making fun of myself.
Absolutely. It's a human thing, right? They say, okay, great. So CJ's not full of himself. I inherently like him more now versus if you would come in bragging about yourself or whatever, the opposite of that would be where that puts up walls around you. Like it's really, I think the difference between senior leaders that are really effective and those that aren't is your ability to relate to people. Being self-deprecating is probably the oldest one in the book in terms of the shortcut to being able to do that.
And as a CFO, you want people to open up and tell you more about their business because you're trying to reflect the reality of what's going on in some damn spreadsheet. And the only way to do that is to learn what they're doing. Certain people I've worked with have this gift where people just open up and tell them everything. And I don't think I'm like there yet, but I envy those people. Like my wife, she isn't in finance, but like people like come up to her in the mall and just tell them their life story. Same thing like with my sister. And sometimes I wish as a CFO, I had that superpower to just get people to be an open book and not have like this kind of artificial wall up at first.
Well, think about those qualities. What is it about your wife, your sister, or others that people inherently feel comfortable doing that? And that's, what you can try to emulate. I think for myself as CFO, the other kind of stigma around our jobs, I'm sure you feel this too, is, oh, you're the curmudgeon in the corner who says no. You're the grumpy guy where everything's always wrong. And, I've heard comments, not to brag or anything, but I've heard comments about like, oh, you're such a nice CFO. Or you're the nicest CFO I've ever met. I'm not used to this. I mean, I don't know why that's the case or why our industry is this way, but that's a differentiator for yourself to disarm people in that way and for them to realize, oh, I'm actually dealing with a human being really helps with coworkers too. We're a remote company at Gladly. We're distributed, so we don't see each other that often. And I really try to get to any in-person event that I can when we do have them, so people realize this is a human being behind the guy who jumps on a call and says, you're spending too much money or no on this, no on that. And, again, to the levity piece, like if we can laugh a bit and understand each other more. Now, when I do get on that call with them and I tell them no, they have that background and that respect behind the reasons why we have to do something a certain way.
So somewhat related to this, Todd, what qualities do you think separate the good CFOs from the great CFOs?
Well, I think probably the most important is the storytelling component. CFOs come up from being accountants or FP&A managers or perhaps consultants in a more financial technical role, which inherently you hear those roles and you think, not the speech maker in the room.
Yeah.
And I think that's often what will differentiate us in terms of who goes on to be a CFO versus who really enjoys being a senior director of accounting or FP&A or whatever it might be, is ability to tell a story, because ultimately you're not reading off a P&L when you're making a public earnings announcement. You're talking about the numbers. I talk about this a lot with our FP&A team. I don't care what the number is. I care why the number is. How did we get here? What is that telling us? Why did we miss to the upside or to the downside? What are the ramifications for the future? If the number is 20 or 25 is irrelevant. Tell me how to think about this and what that means for the future. Ultimately, as a CFO, I'm taking the FP&A story and the accounting story and the strategic finance story and RevOps story, and I'm putting them all together and talking to the board, talking to new investors. Someday I'll talk to the public markets about this. But I have to be able to engage you as a listener. Otherwise, you'll either zone out and not invest in us, or you'll misinterpret and not invest in us. Whatever it is, if you don't understand the exact story I want you to hear, then I'm failing as CFO. So I think that's probably the number one thing to answer your question. Lots of others that I could go into, but that's primarily it.
I think Jim Cook, our friend, formerly of Netflix, Mozilla, and Intuit, I think he'd agree. And he's one of the better storytellers I've met from the finance side or really any side of the business.
Absolutely. To your listeners, And I know he's been on the show, but if there's other circumstances where you can go and listen to Jim, either just go back and listen to that episode, or if you can see him in person at some point. One, he's had amazing experience. Okay, the respect part is there because he started part of the founding team at Netflix. But then, yes, put your point, storytelling, succinct messaging, slides with 2 words on them, these kinds of things where you don't need a whole lot behind you because you're so engaging. That's the kind of CFO that I can really relate to and the story that I want to hear.
Exactly. And when we talk about working with leaders, I think every CEO has a dynamic and unique relationship with their CEO. What qualities do you think drive or forge a good relationship there?
In my mind, at least, a CEO is really a CFO at heart that has lots of other responsibilities. The good ones are, right? Because they have to understand the financials of the business inside and out at a CFO level. And they have to be great storytellers, not just about the finances of the business, but everything else. And I think the CEOs that I've found to be less good are those that rely really heavily on their CFO to come in the room to talk the money side of things, to talk the P&L side of things. They should be able to do that on their own. I have a ton of respect for our CEO, Joseph Antonelli. And I'm not just kissing up to him because he's my boss, but because he's somebody I look up to in terms of how do you become a CEO and a really respected one. And I see him in so many meetings. I'm there in the meeting, but he doesn't need me because he can spout through any number of the business, any forecast, any historical. And I just think that's a huge differentiator for CEOs to be great. And in terms of that relationship between CFOs and CEOs, one thing that he told me when I joined Gladly almost 5 years ago now was never let me get ahead of you. So when you're anything that falls into your realm, you need to understand that at or better than I do and before I do. And that's something I've always really tried to keep in mind is if I'm about to go into this meeting with him, is he going to ask me about this? Because if he does, I don't have an answer for it. And he probably already does. I need to make sure that I'm prepared on this topic. And so that's something I think about. Ultimately, it's how can I fit like a puzzle piece around him, whatever his strengths or weaknesses are. And so if called upon for anything in any meeting with an important investor, customer, et cetera, I'm there with that information and I haven't let him get ahead of me, which isn't easy. He's a smart guy.
Don't let me get ahead of you is such a powerful statement. Todd, does that extend to just also what you do in the business day to day?
Definitely. And I portray it down to my employees as well in terms of from an FP&A side or an accounting side or RevOps, or I manage IT and legal. I've hired all of you because you're smarter than me and more expertise than me in those fields. And I'm going to look to you to make sure that you're playing at that level. And they do. I mean, the reason they still work here is because they do, and I can rely on them to that level. I often think of myself as a chief miscellaneous officer. I don't know if you do as well, but it's just there's so much breadth under a CFO in terms of just random things that pop up that are all of a sudden important. And you can't do that job effectively if your team isn't expert across all of those miscellaneous topics. And that's how I've found to be successful in that regard.
It is funny when you say that because there are a lot of things that come across my desk that I think people went through like this thought pattern, like it doesn't go to him, it doesn't go to her. All right, I'm just going to call CJ up and see what
it must
to do
be a
with
CJ thing. That is right. So the whole BS bucket that we sit in, BS tends to roll downhill. That's okay. That's okay because again, that's your value. That's the reason they'll never get rid of you there.
Yeah.
So you just have to have the team ready to help support that.
What we're going to do next is I'm going to take you into what we call our long ass lightning round. So I ask everybody on the show, give me an example of something you've messed up in your career. We're all human.
I'm glad it's long ass because that could be a long answer for something like that. I think the area that I'd probably hit on is actually something I just mentioned recently about, I think there's this phase that everybody goes through in their career as they get more senior of, there was a time when I hired a head of FP&A. And in my mind, I'm thinking, oh, wait a minute, forecast the business, understand the fundamentals, report to the board. That's my job. Like, I'm running finance. If I hire a head of FP&A, what am I going to do? Because that's what I've been doing my whole career when I was more junior. And that's very common, but it's also, you have to get past that. You have to realize that by hiring these people that are smarter than you, more experienced at a specific thing, et cetera, that opens you up to be way more strategic as an individual, where you can now go partner with the CFO with all that knowledge from the head of FP&A and make strategic decisions on behalf of the business and be a great resource to your CEO. Whereas if you perhaps hired a more junior FP&A person because you were intimidated by the fact that, whoa, that's my job. You can't do all of that. Now you're way less effective of a senior leader. So I think that's something I went through, at least from a thought process perspective of like making sure that I was hiring at the right level and having some hesitancy about it early on. And perhaps that means you don't hire the right person. Then you hire the right person and you say, wow, yes, I'm doing way less FP&A, but yes, that's a great thing for the business and for my own career because I can expand in all these other ways.
Especially if that's what got you to the seat, because I came up in the FP&A world, and at first you're like, whoa, wait, that's what I'm good at. That's what I do. That's what I enjoy doing.
Right.
I have to give this up and now do these other things that I'm not that comfortable with. It's kind of like you're giving away your comfort blanket in a sense of what you fell back on.
Yep, which means, you won't grow unless you do that. You got to jump into the deep end at some point. Yeah.
All right, I'll go read all these procurement contracts.
Exactly.
If you could tell your younger self something, knowing what you know today, what would you tell him?
So I'll summarize it as we'll see. And I'll explain what I mean by that. I'm going to take you to two short but kind of tumultuous stories from my career.
Cool.
One, my first job in financial services industry, I lived in Milwaukee, Wisconsin, worked for this great private company called Strong Financial Corporation. Founder CEO is Richard Strong, really dynamic guy, dynamic speaker. Everybody loved him. It was a great culture. About a month into the job, news trucks showed up out in front of the office, and Elliot Spitzer, who was the New York State AG at the time, was kind of doing his reign through the financial services industry, looking at all of the potential wrongs, trying to make a name for himself before he ended up getting in serious legal trouble himself, but we won't get into that now. And he indicted our founder, Richard Strong, on late trading charges related to the timing of trades in the mutual funds that he managed. And so all of a sudden, he was indicted. We had to force a sale to Wells Fargo. And I'm 22, I'm a month into my career and just thinking, oh my God, I made the wrong decision on where to work. This is going to be a stain on my resume. Like, am I going to get another job? I was an incredibly junior level person there. It was okay. It worked out all right. But it stayed with me. Fast forward to, I went to MIT for grad school, for business school. And between first and second year, you take an internship. And I chose Lehman Brothers, proud, long-standing financial institution. I was really excited to get involved. First day on the job, I got a call, and it was from HR, and they just said, hey, it's great to have you here as an intern. We'd appreciate it if you didn't talk to the press while you were here this summer. There's a lot swirling going around in the financial services industry right now. We really don't want any communication coming from the interns, which is fair. So I should mention this was the summer of 2008. And so throughout the summer, I saw as this 100-year-old institution started to crumble along the edges, and the leaders were saying, we've been around for a century, we'll get through this. This is no issue for X, Y, and Z reasons. We realized Bear Stearns just crumbled. That's different. Here's what we're different. And then ultimately into the point where it ultimately collapsed. And so in both of those situations, I'm thinking, one, I'm just terrible at picking jobs. Two, is this the right field that I want to be in? And where's my career going to go? And getting back to this whole we'll see concept, it's not something I've made up, but when bad things happen to you and you think that they're going to be negative and permanently negative, like there's no way this isn't a horrible thing, you just really have to wait and see what it leads into next. And so, because of that, those two circumstances, I thought maybe it's time to get out of investment management. I'm at this technical school of MIT. All my friends are going out to the Bay Area and joining tech startups, and I don't know anything about that. I would never get a job there. But that really forced me to look at it. And ultimately, I was able to pivot. I got a great job at PayPal when I first moved out here. And, I was going to do, maybe 2 years in California. And that was 15 years ago. And it doesn't look like I'm turning back. So you just never know as these things happen. And negative things can turn into really positive ones and vice versa over time.
Wow. Those are two great vignettes. We spoke with Chad Gold, the CFO of G2, and he said that he always wanted his teams to, quote, make the news. That when the news trucks pull up, though, and you're a finance person, I think that's a bit of a different definition.
Yeah, they don't usually pull up when you've hit your number for the quarter or release something great from a product perspective. They usually pull up when something's very wrong. So, yeah, I agree with you. There's different ways of getting in the news.
Being at Strong, though, when that happened, even though you were younger and you obviously weren't responsible for what happened there, you are like very impressionable and you're like, holy shit, what is going on? Like, is this the end of like me working in finance? You probably go through all these crazy, thought patterns in your head.
I mean, I think that's it. You are so young in your career that you just think, well, I saw this in the movies, but I thought it was just totally theatrical and this would never happen. But I guess this is just kind of what happens with companies over time, and it's just a matter of time. And yeah, a lot of lessons learned there. But ultimately, it is those times of crises when you look at your leaders and see how they act, right or wrong sometimes, but you turn towards really strong leadership, and those that are really strong, that have been through those kinds of things, episodes before, hopefully not the illegal kind, but just the market crashes, etc., are those that are so valuable in the future.
Yeah. And if you ever hear somebody yell, "Get the shredders," then it's probably time to look for a different job.
Yeah. Get the shredders and update your resume. Yeah, that's for sure.
Okay. On a lighter note, can you walk me through your finance software stack? Roll the theme music, producer Nancy. And with that, it's time to rep yo stack, sponsored by Tropic, the next-gen procurement platform helping modern CFOs take control of their budgets and bottom line. By combining approval workflows, supplier management, and pricing benchmarks all in one place, Tropic makes savings opportunities easy to find and act on. Visit tropicapp.io to learn how. What are the tools you're using to get the job done today?
I think we need more, ultimately. And that's certainly what my team tells me. So that's a priority for us. We use a lot of the common folks. So NetSuite, Salesforce, we use Looker for all of the usage revenue counting that we talked about earlier. You have to have a good system to be able to count all of that usage. So we use that. ADP, Bill.com. But there's so much innovation going into fintech now that there wasn't for the last couple of decades. Like, it's finally caught up to finance. And it seems like every day I'm talking to another founder with a solution to disrupt Bill.com or ADP or these others. And so it's certainly a concentration of mine. I mean, we need FP&A software. We don't have it right now. My poor head of FP&As, we're still all Google Sheets. So yeah, that will catch up with you pretty quickly too.
We have a lot of FP&A vendors who listen to this. So expect about 12 emails when this comes out. Sorry ahead of time.
Great. That's great. I appreciate it.
Shout out NetSuite, sponsor the pod. What's the most recent tool you bought?
It's probably, we've had a lot of these for a while. I just renewed NetSuite for 3 years. So sponsor the pod.
There we go.
They're a great product. We just doubled down with them. I think, with all the stuff that you buy at our stage, it's about, can we go public with these? You've got to really make sure, even if it's the nifty new tool that's better than something for whatever reason, can you hyperscale on this thing? Because I don't want to replace these, if at all possible, for the next 3 to 4 years until we go public.
All right, last one I got for you. In all your years in finance, what's the craziest thing you've seen someone try to expense?
Man, there's a wide variety. I'll always go back to somebody expensed dental surgery on their corporate card. And the excuse was, I was in a haze from the anesthesia and I thought I grabbed a different card. But I guess they never realized it all the way through expensing it. So that one got denied. We did have a good conversation about it, but it just shows you gotta keep a keen eye out there, whether it's malicious or not. It could be an $8,000 bill that comes through.
Did not smile about that one.
I wasn't. Yeah. He had a beautiful smile, but I wasn't smiling.
Todd, thanks for spending time with us. It's been amazing to dig into usage-based models and also learn about how you run your teams and how you're scaling it gladly.
This was such a pleasure. I really enjoyed it. Thank you for the time and the questions. And I love the show. Keep going.
Appreciate it. Roll the credits, producer Natalie. Run the Numbers is part of the Turpentine Podcast Network. It is produced by Natalie Torren and edited by Justin Golden. Album artwork by Some AI Thing. Yelling and intro by Fat Joe. If you made it this far, please give us 5 stars. I really need this.